Hello, folks.
Hey there.
We are going to be running a presentation over some payroll tax stuff and some bookkeeping side of things. So we have two topics for this week. We're going to get started here soon. For those of you watching on the webinar, don't have too many folks joining today, so we will probably just do a little bit of our own question and answer at the end. And from there, we got some interesting topics for you this
Yeah.
week.
Well, we're always live every Friday at 2 p.m. Central Time. You're always welcome to hop on, ask any questions, and maybe might be some new knowledge you get from hopping on live. So
If you have questions too, and you've seen our topic go out and you're like, it's not related to the topic, feel free to come anyway and ask
mhm,
any kind of general questions you might have. Our topics are sort of more guidelines
mhm,
than hard topic discussion points. So
exactly. Yeah. So today's topic on the tax side of things, this is a pretty common one that a lot of clients have. It can trip people up, and that is whether or not costs that you're incurring for the business need to be expensed or capitalized. And so what that means is, are you putting it directly onto your P&L? You're writing off that expense right away, or are you treating what you bought as an asset and you kind of need to take that deduction over time in depreciation? So let's take a look at what that looks like. So when you have an expense, what you are reporting on your books and your financial statements is that you paid for something and you've used it immediately. That there isn't really a long-term tangible benefit to whatever it is you paid for. It's useful for your business. You used it right away. The biggest thing is, of course, there's nothing to be resold. You can't use part of it and then give it to someone else. It's kind of an all or nothing kind of situation. That's when you would expense something. Versus when you capitalize a cost, there's inherent long-term benefit to whatever it is you're buying. And oftentimes, whatever it is, you can resell it at a later date, probably for less than you bought it for. But there's still value in that asset later on. Um, Usually the biggest telltale is, really how expensive that thing is. That's kind of the easiest way to tell, if you're paying a few $100 for something that you're only going to use for a little while in the business, an expense, something that might cost tens of thousands of dollars that you're going to use for many years in the business. It's going to be something capitalized. So let's take a look at some examples of what you'd expense versus capitalizing. So some good expenses would be rent and utilities, anything you're paying on a monthly reoccurring basis. And that's, funds leaving, they're not paying down a liability or anything. It's probably an expense. Things like you're paying to your employees, almost always, all of that's going to be an expense. Any supplies or any small tools that really have a pretty limited life in your business. You're definitely going to use them up within a year, probably a lot less than that. You can expense those as well. And any routine repairs, you're not improving anything that you own. You're just keeping it in a state where you can continue to use it. Things like that would all be expenses. Capitalized costs, those assets that are going to have value over time, things like furniture and equipment for your business, vehicles, those are going to maintain their value over time. You're going to use them over time. The buildings and land that your business uses, obviously those aren't going anywhere. Definitely resell those, but they still have use to your business, so you get to capitalize those on the books. Leasehold improvements and major renovations. So maybe you don't own the building your business operates out of. You had to build it out to get it to where your business can use it. Since that is an asset and it has long-term value, that's also something you'd capitalize. You wouldn't just expense that as you're paying for it. If you bought a new business or bought one from an existing operator, there's going to be intangible assets then that you're dealing with. The goodwill, the value of the business you purchased, or maybe that franchise license that you bought from the franchisor. Since you're going to be able to use those for many years, those are also capitalized costs. This one's a little bit different as far as inventory and raw materials. Those are costs that do initially go on the books as an asset, but as you turn those into sales, either selling your retail inventory or maybe converting them into a final product, that's going to get eventually converted into cost of goods sold, which does go as an expense, but those initial costs, those are what you're capitalizing. And of course, when you capitalize an asset, you still get to, get some benefit out of that on the P&L, and that is depreciation and amortization. You're recognizing that over the life of that asset that you just bought, you're using it up, it's losing value, and that needs to be reflected on the P&L. That always starts whenever you place an asset in service. For most things, that's when you buy them. You're not usually going to buy something for the business and then hold on to it for a while before you start using it. There's some instances like that. Maybe you're doing a build out for a new shop. Maybe you're building a new building, things like that where, you're paying for it up front, not quite using it just yet. But once you do start using it, that's when you get to start taking the depreciation. For the most part, most small business owners would just choose to use straight line depreciation. There's several different methods you can choose, but straight line is usually the most applicable for small business clients. And that's simply your initial purchase price, everything you paid for that asset, less whatever you think you'll sell it for at the very end of its life that you can't possibly get any more use out of it, divided by that useful life. And that's the depreciation deduction that you get to take every year for that asset if you're using straight line, which would almost always be the case. The IRS does make it a little bit easy for you, so you don't really have to guess as to how long you're going to use an asset or do too much of your own judgment. They have several different categories that that asset will fall into, and you will use their depreciable life for tax purposes. In my experience, most clients are perfectly fine with having depreciation on a tax basis, since that's what they care about the most anyway. What are they going to be able to deduct on their taxes? So you got 5-year assets. That's most typical assets that you're going to use. So machinery, equipment, vehicles, computers, and anything like that. It's pretty normal business equipment is going to fall under 5 years. 7 years for any furnitures and fixtures. So certainly office furniture, maybe furniture that your clients are using in the waiting room, things of that nature that can still be removed from the building. Then you got 15-year assets. The biggest one here is going to be leasehold improvements. So anything you paid to get the space that you're renting up to where you need to use, can use it, that's going to be depreciated over 15 years. Again, the difference between that and furniture is whether or not you can physically take it out. You can walk out of the building with it. If you can't, it's going to be a leasehold improvement. And then you've also got those intangible assets, goodwill and franchise licenses. Those are also going to be amortized over 15 years. And the only difference between depreciation and amortization, depreciation's for tangible fixed assets, amortization's for intangible assets. Assets you can't just physically pick up and hold in your hands. So goodwill and franchise licenses are the main thing that apply to most small businesses. And that 15-year life is kind of regardless of how long the franchise license is for, how long you reasonably think the goodwill you bought from the previous owner is going to be realizing value for you. And then, of course, you've got buildings, residential buildings, so single-family home, duplex, quadplex. If it's residential, it's 27.5 years. And then pretty much any other kind of building. There's some exceptions for agriculture. We don't have a ton of ag clients within our portfolio. But for the most part, any other building is all going to fall into 39 years. Another big one is land. Doesn't depreciate. Almost always in the real world, that land is going to be worth more when you sell it than when you bought it or when you're done using the land. There's some exceptions when you're dealing with resource extraction. Don't have a ton of clients doing that, but that would be a little bit of a different way to measure things. But for all intents and purposes, for anyone watching this, land isn't going to be depreciated. It does need to be separated then from any of those building assets. But that's not all. As you may be aware, the IRS does offer some tax benefit to small businesses in the form of accelerated depreciation. So even though that asset might last you 5, 7, even 15 years, even based on what the IRS is saying it's going to last, they are letting you accelerate that depreciation so you can take all of it in the very first year. So it really, tax-wise, doesn't end up being that different from if you had just expensed it. Now, of course, the biggest difference is it does still end up on your balance sheet as an asset. So whenever you go to sell it or get rid of it, there might be some acute depreciation recapture that you'll need to deal with at that point. But the accelerated depreciation, that's going to apply to any fixed tangible asset with a less than 20-year life. So really from the last slide, the only thing that wouldn't include would be any intangible assets like franchise licenses and any buildings. So there's some special rules for vehicles. That's the only other real exception, but certainly any equipment, computers, furniture, and leasehold improvements that build out on your new facility. Those are all going to take advantage of that bonus depreciation. So one other one that trips quite a few clients up is this business startup cost concept. So the whole point of capitalizing and depreciating assets rather than just expensing them right out is the accounting principle that your costs and your expenses should go on the P&L at the same time you're actually realizing benefit from those assets. You're actually generating sales. You're making money from them. And so when you're starting a brand new business, of course, you're going to incur a lot of costs. And in all likelihood, a lot of those are probably going to be capitalized anyway, your build out, your franchise license, things of that nature. But there certainly are going to be costs that if you were already open, those would be expensed, maybe marketing costs, maybe you've already brought on employees and you've already started paying them even before you're open. Because you haven't opened yet, you haven't started generating any sales, those costs actually are also capitalized. It's called a business startup asset. And that asset's placed in service when the business opens. You generate that first dollar of sales. And like other intangible assets, it's amortized over 15 years. There's no 100% accelerated depreciation, but you do still get 5,000 that you can amortize right away if you have under $50,000 in business startup costs, which because that's separate from most other assets you capitalize anyway, a lot of small businesses are going to fall under that 50K cap. So that is what I have for expenses and capitalized costs.
Well, before I take over with my extremely interesting payroll topic, do you care if I ask you just a couple questions and I'll play the role of the audience here? So just a quick one here. What is the best way to distinguish like a major renovation from a routine repair? Say I was like a small business and I had like a bathroom in terrible shape and I made it look really nice and cleaned it up. Would that be more of a routine repair or a renovation?
So it really comes down to whether or not you are increasing the value of that asset.
Okay.
So if maybe you have your building that you're using for your business. If you're just repairing the toilet or maybe you're fixing a plumbing issue, might only cost a few $1,000s. That's going to be a repair because all you're really doing there is maintaining the integrity of the asset you already own.
And the bathroom functional.
Yeah,
Okay.
exactly.
Okay.
But if it's a brand new bathroom,
New tile.
new vanity, everything in there, that's going to be capitalized as a new cost.
Okay.
It does come back a lot of times to that really how much you spent on the project.
Right.
That's kind of a good rule of thumb. If you're spending tons and tons of money, it's probably going to be capitalized. If you didn't spend that much money, it's probably going to be expensed.
I think the only other question that I really drummed up while you're sitting there, is there anything like land that doesn't depreciate, or is land pretty much the only one in that category?
Land's the biggest one. Generally, if you have any weird assets that are used for the business, but aren't actually losing any value, that would maybe be an instance of you wouldn't depreciate the asset. Maybe you purchase some sort of license that it more or less is indefinite. Maybe you have like a 99-year license on something, and that license is going to be worth more money in the future, even though you're using it right now. Something like that you could probably not amortize.
Okay.
But it is pretty rare to have a situation like that outside of maybe resource extraction, like natural materials type of thing, like oil production or
mining of some sort. Yes. All right. Well, I will move on to our very interesting payroll topic this week, which is just going to be some timekeeping tips. Really, The reason we're going over this is we've talked to some folks and found out that, timekeeping is being kept on paper and all kinds of stuff like that. And I'm just kind of collected some of the reasons why we encourage folks to try to get this on a system and what those benefits, those pros and cons would kind of be if you were to do that. So, oops, I just skipped way too far. So, just some of the basic issues that we're seeing with informal systems, using like keeping things on a piece of paper or trying to remember them, they do just add a whole lot more human error. You're relying on someone to tell you how many hours that person was working. Then you're writing them down on a sheet of paper. You got to keep track of that sheet of paper. You got to pass it along to whoever sends it to your payroll folks. So, the more, handing around of those documents, the higher of a chance you have of having somebody misread something, mistype something, etc. And so that's probably the biggest issue is these informal systems have a lot more error than the machine who's got a more regimented system than we do. So those informal notes can't really reliably track in employee clock-in times either. So, you might be getting from your managers or whoever on site, oh, so-and-so came in at 8, they came in at 8:30, but you're not getting like an accurate, hey, they came in at 7:59:47 on Monday, they came in, 8:01 on Tuesday. The apps, the timekeeping programs, they do a lot better of a job of keeping an exact time on when folks are coming in. You're not getting an estimate. You're not getting a, oh, I heard so and so came in on 8 at 8. You're getting just a very, detailed record. They clocked in here, they clocked out here. Um, when you are doing these inconsistent time tracking practices, and it's increasing the risk of errors, it can cause problems like if you have someone dedicated to this and they are absent one day, you might not have someone who can take care of this or someone who knows exactly who to reach out to. And so if you have a program, a lot of that's going to be handled on the program side of things, and you won't have to worry about having some dedicated person who's lording over these payroll sheets and trying to make sure, oh, did we get X sent? Did we get Y sent? It's just taken care of for you. If they're getting passed from person to person as well, I've seen this before. You hand a sheet off, next manager makes a bunch of notes on that sheet, hand that sheet off to someone else, makes a bunch of notes, and by the time that sheet is complete, there's stuff all over it, and it becomes very hard for the employer to decipher exactly what is trying to be told to them. Then they have to go call their managers, figure out exactly what happened, get all that detail. So then, you're basically having to gather that information twice. So why we recommend that formal system. Like I said, it will accurately track when employees clock in and out. So, when I hit my clock in, it's telling me down to the second what time I clocked in at. My boss is able to check all our time. They can see, hey, Evan worked for 8 hours and 2 seconds today, and we know for a fact that's when he clocked in and clocked out. So that removes a lot of the guessing. Some also offer geolocation features. So if you're running something like a maid service, and you're like, I don't know when so and so actually got onto site. Some of those apps can help track that. You can set basically a geo fence and say, hey, as soon as Mary comes across that line, I want her to clock in. And then, the app will take care of that for you. As soon as she heads out, clock her out. And then it'll say on that app, X amount of time at that site, doing whatever you had Mary doing. So that can really just get a much greater detail on what the employee was doing, where they were doing it, what times they were doing it. They also reduce just the stress and burden on the individuals who are managing the employee time. So if you're an employer and you're trying to manage all this time on your own, you know that it can eat up a ton of your own time. You're trying to do timesheets at the end of the week, make sure everything's getting out on time. That is going to be totally removed if you have an app. You're basically going to be logging in to make sure payroll is correct a lot of the time, and it's going to remove a lot of the issues when it comes to timekeeping. Might still have people coming in to you like, hey, I forgot to clock out or I forgot to clock in. But then you're down to a program. It's as simple as usually pressing a little edit button and then changing the time on it. So you've got it tracked then anyway. So it does just make it a little smoother. Your manager can then handle it on the spot then, and then it's in the system on record. And over time, this is going to make everything just way smoother, and it'll be easier to identify errors because if you've got someone who's working 40 hours a week and they come in and they've got 68 hours on this one, you're probably going to realize, hey, I don't think they clocked out or whatever happened at the time. You're going to see it. It's going to look funky because you've got a regimented system. And it also just generally speeds up all your processing time. Since it's all being logged for you, tracked for you, you don't have to do all this goose chase stuff. going to make it quicker for you to pay out at the end of the week. But also another thing is, I'm not sure how many folks have issues with this, but time disputes can be a problem. You know, employees not remember when they clocked in, telling you they remember a different time than your manager, you know, stuff like that, especially when you've got just kind of guesstimation going on and you're reaching out to folks. There can be a lot of time disputes and folks can get confused. They can have different opinions on what happened. And just this removes all that. You know, you don't have to figure out, there's no debate. There's no, hey, I said this, they said that. You clocked in at this time. You know, if there was an issue, you got to let me know. But other than that, you clocked in, we got a record of it, clocked out for lunch, whatever the record shows. And you know, having it in a centralized system, it makes it easier to prevent those disputes, but it also is going to get way more transparency on the employee side because they're going to be able to log in, see all their time, see, hey, I am actually logged for, you know, 32 hours or whatever they worked this week. They can see, you know, what times they clocked in, what times they clocked out. And that's just going to, I find that it typically makes people feel a lot better when they can log in, view their own time, see, hey, I'm not being shorted, nothing funky's going on. You get less complaints just kind of in general about it. And lastly, I'll give you what we offer for this solution here. We offer a service called Swipe Clock. It's a newer service that we just started offering not that long ago. It's got several tiers. So, you know, depending on what level of timekeeping help you need, it's got a couple different price entry points and different services that they offer. That basic tier that we have is going to be just your app to clock in, clock out. So if you are keeping things on paper, I really highly recommend looking into this. It is going to just be, you know, it's a phone app. They're able to clock in, clock out, or I believe it can be ran on a computer as well. So it just sort of really removes a lot of that paper bookkeeping issues that you have to do when it comes to your payroll side of the house. The higher level tiers, they have that geolocation feature I mentioned. So if you're interested in, you know, I would like to be able to set those geofences, figure out who's going to what site at what time. You can set that up on one of the higher tiers. And the highest tier will offer select HR tools, additional functionalities that you're going to get the whole shebang with that tier. So if you're interested in learning more, please reach out to us. The payroll team, we have all the details on this. So if there's any point that you're like, hey, I'd love to look into that swipe clock issue, you can either hit up the payroll email or reach out to me personally. My name's Evan, and we will take care of that for you, get you the details, and make sure you are playing with the full deck here. And that is pretty much all I have for this session. Probably not a ton to ask questions on, but that's totally okay. This is more of an informational on our end of things this time.
Cool. All right. Well, I think we had another great webinar. We certainly hope you'll join us, each Friday at 2 p.m. Central Time. We've always got the live webinar for anyone to hop on, ask any questions. As always, you can reach out anytime to anyone here at Volpe. We'd always be happy to answer any of your questions. And hopefully we can get you and your business in the right space.
If you happen to be watching us virtually as well, please feel free to share this video. Send it to whoever you want. It doesn't have to be a client. It could be anybody who's interested in this kind of advice. Send it out to them.
Great. Well, until next week, everybody. Thank you so much.